Basically what we do is we buy and sell currencies against the dollar. We do it both for our own account and for the account of our customers. The key feature here is speed, trying to follow what's going on in the international markets so that we can anticipate and catch trends as they occur.
Everyone else is watching, and they're seeing these big negative numbers, and their confidence gets affected.
The Dow Jones Industrial Average dropped more than 900 points.
The market didn't work. It broke down. The machines broke down.
Fear came back into the market in a very big way.
It does mean that we're starting to right some of the wrongs we created over the past couple of decades, but it's going to be very painful.
No-fee trading has transformed the retail trading landscape, making it easier for everyday traders to get in. But a new paper out shows that there are hidden costs with free brokerage accounts, and it adds up to $34 billion a year. It's great to see you and a group of your colleagues placing trades simultaneously. You did it with different brokers. You certainly saw a varied outcome. The outcome really varied significantly. Explain to us exactly what you did and what you found.
So I think the easiest way is we were kind of testing something else, and we're using one broker, and we decided we couldn't run results just on one broker, so we set up a second broker, and so we essentially placed the same trades at the same time for the same amount. And the first day we did this, one broker lost $150, and the other broker made $12. And we said, well, this looks kind of weird. And so eventually we ended up having 6 different brokerage accounts. And essentially every single day there would be a huge variation in how much the 6 accounts made or lost, just simply based on which account we were using, even though we were trading all the same stocks. And so that's kind of what we ended up finding, is there's just a huge difference in execution between the 6 different brokers that we used. And then ultimately we tried to see how much of that was related to the payment for order flow they were getting from market centers. So modern brokers, what they do is, instead of sending your trade to the New York Stock Exchange or to the NASDAQ, they send them to these dark pools, which are typically Citadel or Virtue or other places like that. And essentially what we found is the amount the broker was getting paid for the trades really had no relation to how much execution what price execution you're getting. And there's really no way for you to know ahead of time which broker was giving you the best price execution on these trades and which broker was giving you the worst execution.
So then, Christopher, once people have this information now that you've brought to light, what can they do? Is there anything that they can do differently, or perhaps any sort of recourse now that they've seen this divergence in the difference from these platforms?
In terms of recourse for investors, there's no recourse because there's no rules being broken, no regulations being broken.
Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, global markets reporter at NASDAQ. Joining us at the MarketSite studio in Times Square, New York City, we have Michael Nowotny, co-founder and CEO of Krypton, a next-generation DeFi trading platform that takes an interesting approach to solving the problem of slow growth and trade inefficiencies in DeFi.
So Krypton is a novel DeFi exchange protocol that aims to solve the massive inefficiencies that have been plaguing the growth in the DEX space and the DeFi space. So what we do with Krypton, instead of matching trades based on price and quantity, we match them based on price and trading speed. So traders can express a preference for urgency. This urgency is a public signal that can be digested by market participants. And so someone who has a short-lived signal to monetize, of course, needs to trade fast. But on Krypton, that will move the price against them. And everyone will see that before the damage is done.